Welcome to our channel. You're watching Enterslice. My name is Narendra Kumar, co-founder at Enterslice. Today we are going to discuss about FLDG norms of RBI first loss deposit guarantee. So, if you're watching this video, means either you are a fintech or you are a regulated entity like NBFC and others. So let's stay with me, and I'll let you know the entire regulation related to FLDG. So this video is a detailed presentation that how this guideline works. So FLDG is arrangement between DLG digital lending guidelines and regulated entity. These guidelines are crucial to understand how regulated entities manage their risk. So, for example, you are a fintech and you are providing some FLDG to NBFC. Earlier there was no limit. Now limit has been capped to 5%. Means as a fintech, maximum amount of guarantee you can provide to NBFC, that is 5%. Means if you are doing a turnover of a loan of 5 crores as a portfolio of your fintech, means customer is referred by you and you wanted to provide guarantee, then 25 lakhs can be the maximum deposit amount, that is FLDG. So the entire ecosystem has several challenges because in fintech business there is a probability that you must be lending to high risk customer or maybe defaulted customer. So that depends on your product. So I'm not sure that whether 5% is the cap that will suit to you. This guideline is applicable to cooperative, commercial banks, NBFC, and all other entity whose definition falls under the regulated entity definitions. So DLG is deposit default loss guarantee, refers to a contractual agreement between a regulated entity and a qualifying entity, where the latter guarantee compensated by the former loss of the default. That means if any loss happened because of the guarantee was provided for any customer to the NBFC or other regulated entity, so that guarantee will compensate their losses. For example, if losses is higher, if losses is more than 5%, then this will be unsecured losses, means loss is not secured. Still, you can sign an agreement with NBFC to recover such losses from either from your revenue share of processing fee or whatever commercial arrangement you have with the NBFC. But deposit you can give, that is maximum 5%. So when deposit can be invoked? So deposit can be invoked within 120 days of default. This is the regulation. So earlier with the previous regulation, there was no such guideline, there was no such regulation. So first of all, who can be DLG? DLG provider can be only a company registered under Companies Act 2013. Means LLP and any other type of businesses like proprietorship, like partnership is not entitled to be a DLG, not entitled to provide enter into the DLG arrangements. So you can't be a fintech as a partnership firm. This is what the meaning of this regulation is. So the DLG arrangement must be backed by explicit legally enforceable contracts. Means your contract, whatever contract you are signing with NBFC, it should have all clauses about your product, about the reporting requirement from NBFC, about the KYC requirement, how loan will be collected, and if collection is being outsourced by fintech or by NBFC, it has to be also it has to be defined in the contract. And contract must be legally enforceable. You can't sign something which is legally not enforceable, and must outline the true extent of DLG cover. Means how long you are going to cover the default loss guarantee. This has to be covered and maintained, and the timeline of invocation has to be also mentioned. The disclosure requirement is for forms of DLG. DLG can take various forms including cash deposit, fixed deposit, commercial banks deposit, and also you can provide bank guarantee to the regulated entity. Cap already we discussed that cap is just 5%, but that is 5% of outstanding portfolio of the month, and that has to be calculated every month. Now if there is an NPA can be also set up beyond 5% from your any revenue which you generate as a part of this arrangement. So NPA recognition is very critical. It's critical because that you have to recognize of every individual loan asset as non-performing asset, and subsequent provisioning has to be made. And you know that's the provision is the responsibility of a regulated entity. The DLG cover is treatment of regulatory capital, does not replace regulatory capital. Means, let's say if the regulatory requirement says that 10 crore is the capital requirement to keep your license active as an NBFC for new NBFC, and for old one it's 2 crore, and by 2025 next year you have to reach to 5 crores, and then 2027 you have to reach to 10 crores. But for existing new NBFC who has got new license post this regulation is required to maintain 10 crores of capital. Means DLG will not replace your any of the capital risk. So capital computation and credit risk will remain and governed by the master direction which is insisted for the NBFC. And as I stated earlier, you have to invoke guarantee in just 120 days and reflect borrower rectifies the situation before tenure of the DLG. DLG agreement must be at least as long as the longest tenure of that loans underlying the portfolio. Means loan is for 100 days, then DLG agreement will be for 100 days. And disclosure requirement that as in the balance sheet of regulated entity, every DLG name has to be mentioned, and regulated entity is required to conduct due diligence of the fintech who enters into this DLG arrangement, and such due diligence should not be limited to the profiles, that should also look into the source of fund which fintech has provided as a deposit in the bank account, or as if they are providing bank guarantee, then still you have to do the due diligence. And you have to see that customer origination, data security guidelines, grievance redressal system, everything as per RBI master directions. Consumer rights has to be upheld. Consumer rights can't be violated, and there is no exception for regulated entity in terms of the compliance. So, as an NBFC, if you are working with fintech who are primarily into lending businesses, they are not having license. That's why they are coming to NBFC. So, in such case, you have to be very careful while working with such players, because there are large number of fintech players backed by foreign entity. So that as a regulated entity, you have to look into that. It should be very compliant in terms of the source of fund, in terms of the management, and the agreement which you sign must be signed on the proper stamp paper. It can be digital, but try to sign on stamp paper. Proper dispute clause you have to maintain. Proper arbitration clause has to be inserted, and notice period, arrangement of deposits in case there is a default, in terms of if who will store the data. As an NBFC, you will be storing all data. So fintechs are not required to store any data of their customer. That you have to see their system has to be audited, that whether they are storing some such informations or not. And in case PNL will be recognized as per the regulation applicable on the NBFC side. So this DLG cover will not be a backup of NPA that you just cross off and invoke the deposit. So that's why if in case long tenure is for long time, then agreement has to be structured accordingly if it's for long time. But you need to also understand that this DLG guideline is not applicable for any kind of offline business that you are doing or in branch model. So this RBI has clarified recently, and parts of the customer is king. So customer grievances, their redressal system, their rights, and ticketing system, nodal officer from fintech side, from NBFC side, everything should be written on the website. All schemes related to FLDG and arrangement with fintech has to be written on the website. RBI from time to time has been watching this sector very carefully, and you will see there are a lot of changes coming in this space. Thanks for watching. Thanks for joining us today, and I'm sure that you will find this video very helpful. Do not forget to like, share, subscribe for more content on regulatory guidelines and financial operations. Until next time, take care. Thank you. Thanks for watching. Jai Hind.